Joining me right now on the show is Madhav Dhar from Delhi. Madhav, of course, needs no introduction. One of the earliest investors in India, one of the earliest foreign investors in India as well. Madhav, thanks very much. Great to have you with us here as always. Last week of 2015, and by the way, I was looking at the best performers, the worst performers of the year 2015. And do you know which is the best performing market of 2015?
I'm guessing it's Russia. I'm not sure.
It's Jamaica. It's up 80% YTD. But sadly, I also found out then that it only trades about $1 million a day. So about 1,000th of what the Dow does, I guess. So, I mean, this is not a very liquid market.
Some things are too good to be true. Yeah.
So, as we wrap up 2015, look into 2016, Madhav, what is the one or two sort of dominating themes which I think will continue on, which will roll on into 2016 as well, to you, in your mind?
Sadly, at least to me, I mean, it doesn't make for good TV, is that I don't think there is a dominant theme. I think the dominant theme is, obviously the single biggest change that's happened, which is much hyped, I don't think it'll have a huge impact, is the change in the Federal Reserve stance. So I think the Fed interest rate, as we all know, is the backbone of global asset pricing. So that backbone has shifted a little bit. So I think that's significant, that's important, but it's so heavily advertised, it's so anticipated, that I think whatever had to happen has sort of happened and adjusted. So that, I think, is one big important fundamental shift. The second, I think the US economy is also steadily slightly stronger than expected, which was a trend that's been underway for a while. China has been decelerating actually quite dramatically for over a year, so that's another trend. But these are now extended trends that are in prices. And the biggest extended trend, I think, that is probably coming to some kind of pause or end is the complete collapse in commodity prices, particularly oil, over the last 4 or 5 years. So I think those were trends for this year rather than for next year. So I think next year will be an adjustment of all these things. And frankly, from the way I look at it, and perhaps it's my optimistic DNA, that in the end it tends to be positive. So if commodity prices are as low as they are, therefore that's input pricing for the rest of the world, that's very positive. Interest rates are extremely low but not going down, certainly around the world. That's a very important input price, that's positive. The US economy seems relatively healthy, that's a positive. Some of the big emerging markets, particularly the BRICS, have adjusted or collapsed, certainly Brazil and so on, because of commodity prices. That's already happened. So I guess from my take would be that much of the bad news was 2015, and that year has absorbed a lot of that. So 2016, I think, will be again, it's different for different regions and countries, but I would say a grudging recovery and more than likely a positive year for global markets, including India. So, I don't think there's a dramatic theme out there that, I certainly don't necessarily see it. The last thing I would say is that it may be early, but go ahead, Prashant.
Go on, sorry, Madhav, go on. Sorry, go on.
No, I'm saying, speaking of trends and things that you follow is, one is global, but also local, and the other is also a little bit of both, is I think how we deal with non-performing assets in the Indian banking system is going to be an important theme for next year. And I think the other theme that we'll see how it plays out, just because the sociological signs are interesting, is tech. And the extension in tech, the sociological extension in tech is intriguing. And I think that's very extended, the speculation, the intensity, the complete assumption that disruptive tech is not the new thing, is all that matters. and that absorption in the economy, in psyche, in hiring patterns, in media, I think is an important trend. I think it's very late in that game. I'm not necessarily suggesting that it's going to an abrupt or horrible end, but as a trend, it bears watching. It's the opposite of commodities, actually. One big cycle seems to be somewhere near a peak, the other very big cycle near somewhere at the bottom. So those are important trends.
Right. No, so just to flesh out that last point that you made, you're saying that this entire concern or overbearing kind of a theme that it's, the digital economy is going to disrupt everything, the old economy, that might actually, that logic might turn upside down. It might come to a head in 2016. That's what you're saying, Madhav, right?
I'm not suggesting it'll turn upside down. No, I'm not suggesting it turns upside down. I'm just saying people tend to extrapolate things that are already working, both in terms of pricing and in terms of expectations of how important that will be. Up until 3 or 4 years ago, China was buying all commodity assets in Africa. Everyone was panicked. People thought oil would go to $300 a barrel, that we must prepare for a period of an unusually high and stable plateau in commodity pricing, and the world better adjust to that. So not only has that not happened, it's exactly the opposite. I mean, just in 4 years, it's turned around. Now the assumption is on tech is that this new model will completely dominate, completely overwhelm the old economy. And odds are in some way it will, in some way it already has. I'm just simply saying that trends and psychological and investment cycles tend to go to extremes and then turn around. And you've already had that in tech. There have been many cycles, and they're all real, so they aren't fakes. But they go to extreme extensions. 1982-84 was like that. 99-2000, of course, was the first dot-com thing. 08-09 was that. And we have another cycle here. So I'm just saying that, the difference between, from an investment standpoint, it's different because there are no bank loans involved, which is a wonderful thing about tech. And frankly, there are no public markets involved. So all the money is private. But it affects other assets, and it affects hiring patterns. It's interesting. I had a dinner yesterday. There were 3 kids who were here, about 30 years old, and 5 years ago they were in real estate in Delhi, and 3 years ago they worked for investment banks, and all 3 of them are in tech today. In the space of 5 years, they've changed jobs from one trend to the other trend to the other trend. So, again, I'm enough of a scientist not to draw a line between 3 data points, but it tells you something. It gives you a smell of where things are. I was waiting for you to come on the air, and the commercial at the background was also about tech. And so I'm just saying it's all pervasive, and every time something becomes a self-evident truth, you have to pause and reflect.
Absolutely. Of course, in the U.S., as the S&P has rallied on, it's been led up by a narrower and narrower list of stocks. Of course, prominent amongst those are stocks like Amazon, Netflix, and the tech stocks really over the last year or so, more than a year or so, and that continues.
Exactly.
And that here in India, though, we don't have those big, dominant digital companies. But the argument which is given is that. And by the way, this is given by old-time stock market, people who made money in the stock markets. They say the reason they give for looking at the private markets, the startup world, etc., they say large companies by nature, market leaders by nature, will not be able to spend adequate amount of money and resources to these new technologies because shareholders won't buy it. Questions will be asked, so they can't do it. It's not that kind of investment will not happen. So the thing to do, and so in the public market, in the listed space, the leaders of yesterday will not give you those kind of returns. So you got to look at the unlisted space, the startup world. It seems, the logic seems right about okay. Would you agree with it, Madhav? That kind of reasoning? It's obviously very generalized.
I would agree with. Yes, I would agree with it. I just make another point. I'm just saying every extreme trend is entirely plausible. And there are very good reasons for it. And the reasons you're describing are fantastic, very intelligent reasons. I'm saying it always happens. $300 oil going to 300 and staying there was extremely plausible. It just didn't happen. So I'm just saying every trend always has a very, very intelligent, plausible explanation. Otherwise, it wouldn't happen. I mean, I'll just give you random data. I mean, up until recently, Sony Corporation had the highest number of patents filed of any entity in the world. Sony's managed to reinvent itself as a boring old Japanese company. And yeah, it's still a boring company and so on. But you have to step back and reflect that a big, huge company has filed more patents than any other company in the world. So obviously, big companies have the ability to fund themselves and come up with innovative products. It just hasn't happened recently. All the disruption has happened by startups. So that's an empirical fact. But then to extrapolate that fact, I was thinking if somebody had told me 6 years ago that, listen, I think all the action will be in disruptive tech, and that's where all the money should go, I would say, wow, that's a deep, deep insight. If somebody's telling me on New Year's Eve in 2015, hey, I'll let you in on an investment and great wise secret, which is please put all your money in interesting tech startups that are going to disrupt old technologies in ways you don't understand, I have to say I'm a little skeptical. It's yesterday's news. It's certainly today's news, and there's a small chance it's tomorrow's news. Could be.
Yeah, probabilities.
I doubt it.
Probabilities, right? Probabilities, right? I mean,
and it'll always be plausible. And the thing I want to tell you and your investors is it's always plausible. If it weren't plausible, it wouldn't have happened.
Yeah. But I think what you're saying is very basic and very important, right? When you look at something and you know, people get advice on TV and other places all the time, but it's most of what you actually are getting is, as you call it, yesterday's news, right? It's already happened. It's already, in a way, in the price.
Well, I think so. Again, I guess, yeah, I think the interesting and scary thing about investing is that it always changes. You know, history doesn't repeat itself, but it rhymes. You know, patterns are not always the same, but there are sociological overlaps. I guess my broad point to your viewers would be nobody ever got rich by being late on a trend. So you have to say, I'm actually, this disruptive stuff in tech, by the way, this is not some anti-tech rant. I'm simply saying that things that are obvious in front of your face and have been happening for 3 or 4 or 5 years and have worked and people have made a lot of money on, you just have to be naturally wary of it because that's what attracts everybody. And it's nothing about tech, it's human nature. You know, everybody thought commodities would go up after they'd already tripled in price. Everybody wanted to buy Delhi real estate after it's already gone 5-fold up. You know, nobody will buy the Indian stock market till late next year when it's up a lot and suddenly India's shining comes back again. I mean, that's human nature. And tech is actually the sexiest thing in the world. Commodities isn't. You know, a broad country isn't. But tech is magic. Tech is magic. You know, it inspires. It makes your soul and your imagination float. So when you have crazy possibilities, by the way, it's a wonderful thing because it drives the cost of capital as low as possible for an area, an industry that will truly have the most dramatic positive effects. So I'm all, as I've told you before in a previous show, I'm all for bubbles in tech. I'm all for people, you know, funding crazy ideas. That's what moves the world forward. But as a hard-nosed investor, you also have to realize that at some point, the PE ratios or the cost of capital funding this thing it is going to get hurt very badly. That's the essence of my point. You're the one who started it on trends, so we're talking about trends.
Absolutely. And I think it's very useful. By the way, on the markets changing and history rhyming, there's a great quote. I don't know who said it, but this gentleman, investing legend, I guess, he was asked whether over the 30 years that he's been investing, I think it was Ed Sykota, I'm not sure. He was asked over the 30 years that he's been investing, have markets changed? He said, no, markets haven't changed because by nature they keep changing. I mean, they've always kept changing. So, they haven't. If you ask me now if they've changed, they've not changed. They're the same. So I think.
I totally agree. It just, I think the inputs in and the reason is human nature doesn't change. The reason is that cycles of greed and fear don't change. At the risk of quotes, there's a wonderful little poem by Shelley, which is a trend is a trend is a trend, but will it bend? Will it alter its course through some unseen force and come to a premature end?
No, absolutely. I think pretty relevant. So I'm going to ask you to take a shot. I mean, take a shot in the dark. What will work, you think, in 2016? I mean, we divided things up into years as if, I mean, there is some sacredness about 31st of December 2015 and 1st of January 2016. Markets are the same in a way, right? I mean, it just rolls on into the next year. But still, exactly. What do you think will work from here?
Yeah. You mean just sort of globally, or in India, or in general, or
in India?
All of it?
In India, and in India, all of it. Yeah, maybe. Why not?
Yeah, listen. I have to say I'm a little conflicted because I think on one hand, I think certainly the Indian economy will be picking up a little bit. I think there'll be grudging reform. I think the natural cycle is picking up. I think a government-driven investment cycle will probably kick in. I mean, nothing dramatically, but steadily. So I think we will nose up from 7-ish% to perhaps 8-ish% at a time where inflation, I think, is actually much lower than everybody thinks. And you may get a rate cut or two in addition. So I think that's very positive and coming on the back of a bad year. So I think the odds are the Indian market solves for a good number next year. And I think it's not easy to see right now, but I think we are also, margins are on the low side. So if there's any uptick in growth, which I think there will be, I think there'll be disproportionate returns to margins and profits. So I think Indian profits will surprise certainly 18 months from now, but perhaps even 12 months from now. Markets tend to smell this early. So all in all, I think it should be a very solid and very decent year for Indian equities. So that's my sense. I think the global backdrop is important. My working assumptions are the slowdown in China will get contained at some level, and we are seeing sort of the low point on that. There are lots of stimulus measures they're talking about. Not that I'm optimistic about it, but slides come to an end. And so that's going to happen. But I think India is not as much effective as the entire supply chain of the rest of the world. But I think the supply chain has already adjusted for that to a great extent. So all the commodity countries which have trade with China are absolutely battered and bruised. And Brazil being a classic example, both in terms of the markets and valuation and the currencies. So again, my sense is that the damage that had to be done has been done and largely priced in. So the real wild card is the U.S., is really the big gorilla in the room. And there are countervailing things going on in the U.S. Fed policy has changed. Valuations are still extended. Growth is still decent. Market leadership is getting narrower and narrower. And that is symptomatic of an end of cycle, not an early cycle. So my dilemma, honestly, is that my contrarian side says that things are bottoming out in emerging markets and India will be fine. But my big concern is that if the U.S. start decelerating and changing, it's going to be very hard for emerging markets and India to fight that sort of negative depressant coming out of the U.S. So I'm a little sort of conflicted. All in all, I remain sort of pretty positive. I think we've ended a difficult year, and I think 2016 should be better. And I think Indian assets are probably better underpinned than other areas. I mean, some things are very cheap, like busted up commodities, but it may be too early for that. The one thing, by the way, I've been hearing that I really worry about is protectionism in India. So if steel tariffs go up in any material way, I think that will be massively negative. That's the most negative thing I'm hearing. So GST goes through now, goes through April, doesn't really matter. I mean, I'm assuming grudging positive reform. But if there is an issue with some kind of negative taxation, and in particular any kind of protectionism, I think honestly all bets are off. I think that would be a massively negative signal and a massively negative reality for India. And that will be a shock to the system.
Even measures to counter, what you describe as dumping?
Yes.
In steel, for example.
Yes.
Could you explain that? Why is that?
I mean, I think if it's very technical dumping and it's a one-off, I'm saying that's how it starts, right? It gets backing from domestic players and it gets politicized. So it depends where it goes. I'm saying if it's a one-off technical reaction to a specific situation and it's seen as such, it's implemented as such, perhaps it won't be that bad. But if it's a Trojan horse to a generalized sense that Indian industry must be protected, I think that's a terribly, terribly negative signal. Because that's one thing we haven't had. We've had other reforms not go through or some backtracking. But this is giant. This would be gigantic and incredibly negative.
Madhav, just to go back to the point about US, you said that's a big gorilla in the room. It's been futile to call the top on the S&P. People have been trying to do it for a couple of years now, actually. But again, just to think about it, the S&P, say, for example, is down 15-20% in this year, 2016, actually. Is it still possible that a market here will be up quite a bit by late 2016, markets in India? Can that still work? When that still happen?
I think it's theoretically possible, but I think just historically and empirically it's been very hard. I just think that those things tend not to happen. I think it's possible for India not to be negative or slightly positive, for India to have a very good year and for the US to have a very bad year, especially in the modern globalized world, is sort of difficult. Is difficult. It tends not to happen. So I'd be very surprised if that were to happen. I would say that the underlying economic and corporate environment is such that you could theoretically argue that both those things are possible and should happen, but they tend not to happen because of globalized capital flows, because the price setters are similar, redemptions are similar around the world, and those things tend to matter. So highly unlikely that would happen.
And just to also go back to the point about, you said, well, the underlying growth is picking up, economy is picking up, and I think you also briefly mentioned infrastructure. I don't know if this example fits in, but there's a lot of interest. I'm just using this as an example. From the old, when you talk to old-timers, even institutional money managers, after a long time, I'm starting them talk about the ADAG pack of stocks, not RCOM, which gets discussed quite often because this Geo deal and all these asset sales, etc. But I'm talking about Reliance Infrastructure, Reliance Capital, even Reliance Power, long ignored for years. A lot of interest coming back. You think that's also an example of where maybe the kind of names where money can flow?
Yeah, I think so.
Yeah.
I think so. I think so. I do. I think that if India really starts moving the way I think it should and it ought to and it might, I think that's the area. That's the area that will pick up. I think that will be the lead horse, followed by some banks, followed by brokerages, followed by eventually perhaps the deeper cyclicals, which will probably move later. But that should be the sequence of flows, but it sort of remains to be seen. I think the smell test on growth still isn't there. You talk to a lot of people and they keep telling you projects are moving, et cetera, et cetera. But the one point I do want to make is that there is still overcapacity on the private sector and there is underinvestment, which has been negative for growth in the last 2 years. If government spending kicks in and the top line moves up, but maintenance spending and investment stays low, it's fantastic for margins. So you're going to see the top line grow without costs going up. So I think profits and margins could really surprise 12 to 18 months from now.
Great conversation as always, Madhav. We really appreciate your time. Have a fantastic New Year bash, and hope to see you early in 2016. Thanks indeed.
All right. Happy New Year, Prashant. Thank you.
Thank you.